Welcome to today's Explainer. We're jumping straight into a fascinating and incredibly vital role in the business world, the company auditor. Now, think of them as a corporate detective. They aren't just sitting in a back room checking math. They are armed with serious statutory powers under the Companies Act 2013, all to protect the stakeholders. Let's dive in and see exactly how they operate.
It's a question that gets right to the heart of corporate transparency, doesn't it? Can a company actually hide its secrets from an auditor? When executives close those boardroom doors, can they keep the real financial reality locked away? Well, as we're about to see, the law is designed to grant auditors incredible, almost completely unrestricted access to uncover the truth.
Here's our roadmap for today. First up, the corporate watchdog, followed by the auditor's statutory rights and access beyond the boardroom. Then we'll shift gears to look at their mandatory responsibilities, with the duty to inquire and investigating the red flags, before finally wrapping up with balancing power and duty.
Let's start with Part 1, the corporate watchdog, equipping the investigator.
To be an effective corporate investigator, you absolutely need the right equipment. And in this context, that equipment is legal authority. Effectively discharging an auditor's duties is literally impossible without protection. If an auditor could just be blocked by management every single time they asked a tough question, the whole system would collapse. That is exactly why the Companies Act 2013 steps in. It acts as a powerful shield, giving the auditor untouchable statutory authority to do their job without fear or favor.
Moving right along to Part 2, the auditor's statutory rights, the unrestricted access.
What's truly fascinating here is the absolute nature of these rights. Under Section 143(1), the auditor has the right to inspect the books of accounts and vouchers at all times, and it doesn't matter if those books are kept at the registered office or somewhere else entirely. They also have the right to access the records of all subsidiaries and associate companies when it comes to consolidating financial statements. Plus, officers of the company are legally obligated to provide the auditor with any information or explanations they consider necessary. And of course, the auditor holds the exclusive right to sign that final audit report. They essentially hold the keys to the financial kingdom.
Which brings us to Part 3, access beyond the boardroom, following the trail.
Because, let's face it, a company's operations rarely happen in just one building, right? So, the investigative reach has to extend far beyond headquarters. If secrets are hidden at a branch office, the auditor can go there too. Under Section 143(8), the company auditor is entitled to inspect the accounts of any branch office if they think it's necessary. Even if a separate branch auditor has already been appointed, the company auditor still gets to receive that branch audit report and use it. Crucially, they also have the right to have their final report read before the company at the annual general meeting, blowing it wide open for inspection by any member.
And their presence isn't just a technicality on paper. Under Section 146, the auditor gets a guaranteed seat at the table. Step 1, they are entitled to receive all notices and communications for any general meeting. Step 2, they can attend these meetings, either themselves or through a qualified authorized representative. And Step 3, which is huge, they have the right to be heard at such meetings on any part of the business that actually concerns them as the auditor. They are an active, highly vocal participant in corporate governance.
It doesn't stop at the general meeting either. The auditor has the right to attend audit committee meetings as well. When the committee considers the auditor's report, the auditor must be heard, though it's worth noting they don't have the right to vote there. Also, they have a really important layer of financial protection. They have a right to be indemnified for expenses incurred in defending themselves in lawsuits against the company, whether civil or criminal, provided the judgment actually goes in their favor.
Now consider this a complete legal mic drop from the source material. The above rights of a company auditor are protected by law, and no clause of the Articles of Association of a company or resolution adopted in any meeting can supersede them. Let that sink in. Management cannot vote to take these rights away. The company's own founding documents cannot bypass them. The auditor's statutory shield is absolute and supreme.
Okay, Part 4, the duty to inquire, the burden of investigation.
So now that we know what the auditor can do, we have to look at what they absolutely must do. It's a perfect balance. We have statutory rights, which represent the power to access and ask, but balancing that out, we have statutory duties, which represent the obligation to inquire and investigate. The law doesn't just hand the auditor a backstage pass and call it a day, it gives them a strict, mandatory checklist under Section 143(1). They aren't passive observers, they are legally obligated to dig.
Let's look closer at that in Part 5, investigating the red flags, following Section 143(1).
So what exactly are they digging for? Well, Section 143(1) mandates some highly specific areas of inquiry. First, loans and advances on security. The auditor has to check if these are actually properly secured and if the terms are prejudicial, meaning harmful, to the interests of the company or its members. Second, book entries. The auditor has to investigate if transactions represented merely by book entries are secretly harming the company. And third, asset sales. For companies that aren't banking or investment firms, the auditor must check if assets like shares or debentures have been sold at a price lower than what the company originally paid for them. They are actively hunting for suspicious losses.
And the mandatory investigation keeps going. Next up, more on loans and advances. The auditor has to sniff out if loans have been falsely disguised and shown as deposits. Then, personal expenses. Have the executive's personal expenses been improperly charged to the company's revenue account? Finally, shares allotted for cash. If the books say shares were allotted for cash, the auditor must verify if that cash was actually physically received. And if no cash came in, they have to ensure the account books and balance sheet correctly and accurately reflect that reality so it isn't misleading to anyone.
Which leads us to our final section, Part 6, Balancing Power and Duty, the Ultimate Purpose.
We've seen the raw power, and we've seen the strict duties, but what is the ultimate purpose of this whole framework? The culmination of this intense investigation is pure transparency. Under Section 145, if the auditor finds adverse issues, those red flags we just talked about, they have the duty and the right to bring it directly to light. Any qualifications, observations, or comments on financial transactions that have an adverse effect on the functioning of the company must be read before the company in the general meeting. They take their findings directly to the members, ensuring accountability just simply cannot be dodged.
So I'll leave you with this final thought. Without these untouchable powers and strict duties, could we ever truly trust the financial integrity of a company? The law intricately balances incredible access with a heavy obligation to ensure that the corporate watchdog has real, undeniable teeth. It's a vital, independent role that protects the entire business ecosystem. Thank you so much for joining me for today's explainer on the rights and duties of the company auditor.
If you've ever flipped through a massive corporate annual report and thought, how exactly does an independent auditor legally sign off on a company's financial health? Well, you are in the perfect place. We're going straight to the core of the Companies Act 2013, specifically looking at Sections 143.2 and 143.3. Okay, let's dive into this. This roadmap maps out our journey from the massive macro goals of an audit, right down into the gritty step-by-step legal details. We'll be looking at the auditor's big picture, information and proper records, branches and balance sheets, standards and adverse effects, disqualified directors, and finally, internal financial controls. Starting with Section 1, the auditor's big picture, which is basically the ultimate mission statement for any auditor stepping foot into a company. And this brilliantly illustrates how the law is actually split into two distinct parts. On one side, you have Section 143.2, that broad philosophical goal, but on the other side, Section 143.3, you have a strict operational checklist. You literally cannot achieve that overarching big picture opinion without meticulously executing every single detail on the operational checklist. Let's zoom in on that mission statement. The law requires the auditor to report whether the financial statements give and this is absolutely crucial, a true and fair view of the state of the company's affairs, its profit or loss, and cash flow. I want you to burn that phrase into your mind, true and fair view. It's the absolute anchor point. It is the holy grail of the auditor's duty. Every single receipt checked is just to guarantee this one concept. But, that leaves us with a pretty massive question. How does an auditor actually prove a true and fair view? It can't just be a gut feeling, right? To answer this, we have to transition into the rigorous checklist found in Section 143.3. This is where philosophy becomes actionable law. Which brings us to Section 2, information and proper records. These are the very first actionable steps in the auditor's legal checklist. Now, what's really interesting about this is how we can translate that dense legal jargon into a plain English workflow. Clause A is essentially the detective phase. The auditor has to declare, did we seek and obtain all the necessary clues and explanations? And if not, what is the exact effect of that missing info? Then, Clause B is the foundation. Has the company actually maintained the proper legal books of account? Because if the daily records are a mess, a true and fair view is just impossible to establish. Moving right along to Section 3, branches and balance sheets, where we deal with different locations and final tallies. Let's move to and see how this builds into a chronological workflow. Step 1, as we just saw, is checking if proper books are kept under Clause B.
But what if the company is huge, with branches everywhere? Step 2, Clause C, deals with that. If someone else audits a branch, the main auditor has to state exactly how they handled that branch report. Finally, Step 3 is Clause D. The auditor confirms that the final balance sheet and profit and loss actually agree with all those books and branch returns. It basically ensures the math adds up across the entire corporate footprint.
Okay, Section 4, Standards and Adverse Effects. Here's where the auditor switches from checking basic math to evaluating overall corporate health and rule following.
Take Clause E. The auditor must explicitly confirm that the financial statements comply with the accounting standards. This is the ultimate safety net. It guarantees the company is playing by universally accepted accounting rules, not just inventing their own highly creative math.
Then we have Clause F. This is where the auditor must highlight observations or comments on any transactions that have an adverse effect on the company's functioning. Basically, this is where the auditor has to boldly call out any financially dangerous moves. They aren't just calculators, they are watchdogs. Section 5, Disqualified Directors and Remarks. These are some of the most critical red flag items on the checklist. So, the crucial point is that an auditor's job goes way beyond the ledgers. It points right at the leadership. Under Clause G, they have to identify if any director is actually disqualified under Section 164(2. And under Clause H, they must formally make any qualifications, reservations, or adverse remarks about how accounts are maintained. The auditor is legally obligated to sound the alarm on bad management or sloppy bookkeeping. The law makes it literally impossible to just stay silent. Finally, Section 6, Internal Financial Controls, which is the final overarching system check required by law. Under Clause I, the auditor confirms that adequate internal financial controls are not just in place, but operating effectively. And this beautifully ties everything back to the beginning. Why? Because without strong internal controls, meaning the software, the security, the anti-fraud protocols, guaranteeing that true and fair view is completely impossible. You're auditing the very machine that makes the numbers. To wrap up this explainer, I want to leave you with this question. If an auditor misses a check on this list, who really pays the price? Well, it's not just a typo. When this checklist is ignored, shareholders lose out, employees lose jobs, and public trust is broken. This checklist isn't just paperwork, it is the shield protecting the ecosystem from corporate mismanagement. So, next time you see an audit report, you'll know exactly the rigorous, step-by-step gauntlet those numbers had to survive. When you hear corporate auditor, you probably just picture someone buried under a mountain of spreadsheets, right? Just crunching numbers and double-checking math. But actually, the reality is so much more thrilling than that. The modern auditor is essentially a corporate detective. They are the ultimate guardian of stakeholder trust. And their main playbook for this massive responsibility? It's Section 143 of the Companies Act 2013. Today, we're going to decode their specific duties regarding what absolutely must be included in the audit report. So get ready, because we're about to explore the precise legal mechanisms that keep the entire business ecosystem transparent and accountable. Okay, let's dive into this. Here's our mental roadmap for how we're going to break this down. First up, Section 1, the auditor's core duties. Then Section 2, disclosing risks and losses. Section 3, tracing the money trail. Section 4, the digital fingerprint. Moving on to Section 5, red flags and reasons. And we'll wrap up with Section 6, government company rules. All right, kicking things off with Section 1, the auditor's core duties. This is all about laying the foundation. So, before our corporate detective can even start investigating a company's financial health, they need a rock-solid foundation to stand on. They need a rule book. So you might be wondering, what exactly guides the auditor's pen? Like, when an auditor signs off on a report, officially saying a company's financials present a true and fair view, what actually gives that signature its weight? I mean, they aren't just making up their own rules as they go along, right? Well, the answer to that is right here in Section 143(9). This clause is literally the absolute bedrock of the auditor's duty. It legally mandates that every single company auditor must comply with the applicable auditing standards. These standards are the professional guidelines that ensure consistency, objectivity, and real rigor across every audit. Without this foundation, the rest of the report just wouldn't hold any weight at all. Moving right along to Section 2, disclosing risks and losses. This is where we start uncovering hidden dangers.
Now, what's really interesting here is how the law basically forces companies to drag potential future losses and legal threats out of the shadows and directly into the light. Under Section 143, the auditor has to specifically state whether the company has disclosed the impact of any pending litigations on its financial position. Look, if a company is being sued for millions, we, the shareholders, absolutely need to know. On top of that, auditors must check if the company has made provisions for material foreseeable losses. This includes long-term contracts and, yep, even those highly complex derivative contracts. It's all about making sure the company isn't hiding a ticking financial time bomb from the people investing in it. Next up, Section 3, Tracing the Money Trail. Let's follow the cash. This right here is perhaps one of the most critical roles an auditor plays. Following where the corporate cash is actually flowing and ensuring stakeholder money is safe. First, the auditor checks some standard but absolutely crucial compliance items. They've got to report if there's been any delay in transferring required amounts to the Investor Education and Protection Fund, or the IEPF. They also have to verify if the dividend declared or paid during the year strictly complies with Section 123 of the Companies Act 2013. Basically, this ensures that when a company promises profits to its shareholders, that money is handled exactly according to the law, and unpaid dividends end up exactly where they belong. But here is where the money trail gets truly intriguing. You have to ask, are funds secretly changing hands? In our complex global economy, companies can sometimes be used as, shadow conduits to move money around or to obscure the true owners of capital. And the auditor? They're tasked with making sure that is absolutely not happening. And this brilliantly illustrates how the law works here. It establishes this mirror image net designed to catch companies that are acting as secret middlemen. Let's break it down. Under Subclause 1, the auditor has to get a representation from management that no funds have been advanced or loaned to an intermediary with some secret understanding that they'll just pass it on to an ultimate beneficiary. And conversely, under Subclause 2, they must ensure the company hasn't received funds from a funding party to do the exact same thing on their behalf. It's a clever dual-sided net, really, preventing the company from being used as a money laundering shell. But, the law doesn't just take management's word for it. No way. Subclause 3 actually requires the auditor to do the legwork. Based on reasonable audit procedures, the auditor has to confidently report that nothing has come to their attention that would cause them to believe the management's representations about these money trails contain any material misstatements. They have to actively verify that management isn't, lying about where the money is coming from and where it's going. All right, moving into the modern age with Section 4, the digital fingerprint. As business has fully moved onto computers, the rules obviously had to adopt to prevent new types of fraud. So, for financial years starting on or after April 1, 2022, companies must use accounting software that includes an audit trail or an edit log. Think of this as an unalterable digital fingerprint. Anytime a transaction is entered, changed, or deleted, the software has to permanently log who did it, exactly when they did it, and what was changed. This makes it incredibly difficult, literally almost impossible, for someone to quietly go back and cook the books. Let's see how this builds into a strict, 4-step operational checklist that the auditor must verify regarding the accounting software. Number 1, does the software actually have an audit trail recording facility? 2, was it operated continuously throughout the entire year for all transactions? 3, can they confirm the feature hasn't been tampered with or secretly disabled? And 4, has this audit trail been preserved according to statutory record retention rules? The auditor must report on every single one of these points to make sure those digital records are practically bulletproof. Now for Section 5, red flags and reasons. We're talking about the whistleblower role. So what happens when the auditor actually finds something wrong? Well, under Section 143(4), the law is exceptionally clear. It says the report shall state the reasons, therefore. If an auditor answers any of those required reporting matters we just talked about in the negative, or if they offer a qualification, which, by the way, is basically auditor speak for, hey, this is mostly right, except for this one big issue, they are legally bound to explain exactly why. They can't just say no and walk away. They must document the basis for their unfavorable answer, providing a massive, clear warning signal to investors and regulators. Finally, Section 6, Government Company Rules. Let's look at the CAG's oversight. So the crucial point here is that when public money and state control are involved, there's a unique extra layer of government oversight added right onto the auditor's plate. For government companies or those controlled by the central or state governments, the standard rules just aren't quite enough. Under Section 143(5), the auditor has a dual duty. They are specifically guided by the Comptroller and Auditor General of India, or the CAG. The auditor must include in their report the specific directions issued by the CAG, the exact action the company took on those directions, and, this is key, the impact of those actions on the accounts and financial statements. It's a really rigorous extra layer of accountability specifically designed for entities handling our public resources.
Which brings us to our final thought. How do these really stringent reporting duties ultimately build a healthier, more transparent corporate ecosystem? It's easy to look at Section 143 as just a dry, boring legal checklist, but I challenge you to see it for what it truly is. Whether it's forcing the disclosure of massive lawsuits, tracing hidden money trails, locking down digital edit logs, or demanding hard reasons for red flags, these rules are the essential armor protecting the integrity of the business world. They ensure that when we look at a company, we are actually seeing the truth. Thanks so much for joining me to decode this incredible piece of corporate machinery. Keep questioning, keep learning, and I will see you in the next explainer.